What was supposed to be America's economic masterstroke is quietly turning into one of its most damaging miscalculations in modern history. For years, the promise echoed across factory towns and political rallies: bring manufacturing back home, weaken China's export dominance, and restore American economic power. But as we dig into the actual data emerging from both Washington and Beijing, a starkly different picture comes into focus. One that challenges everything we've been told about who's really winning this economic confrontation. In the first 6 months of this year alone, China's trade surplus swelled to 6.4% of its total economic output. That's the highest level recorded in over 10 years. To put that in perspective, during the third quarter, Chinese exports surged past the $990 billion mark, approaching a full $1 trillion in just 3 months. These aren't the numbers of a nation buckling under economic pressure. Instead, they reveal an economy that has learned to adapt, pivot, and capitalize on the very strategies designed to contain it. Across the Pacific, American households and businesses are experiencing something very different. Consumer prices continue their upward climb. Manufacturing facilities are reducing production schedules. Employment opportunities are contracting month after month. Even some of the administration's most vocal supporters are beginning to acknowledge an uncomfortable truth. This economic battle isn't demonstrating American strength. It's exposing critical vulnerabilities that grow more serious with each passing quarter. Every additional duty imposed on Chinese goods, intended to pressure Beijing into submission, ends up as an added expense absorbed by American companies and ultimately paid by American consumers. This is why senior economic advisors, including Treasury Secretary Scott Bessent, have started floating the idea of extending negotiation periods. Not because they've achieved their objectives, but because the alternative is watching the damage compound further. The harsh reality crystallizing before economists and policymakers is this: China isn't retreating in this confrontation. Instead, it's methodically positioning itself for a far more significant strategic victory, one that extends well beyond simple export statistics and strikes at the foundation of America's industrial and technological capabilities. When protection becomes self-sabotage. The tariff campaign was marketed to the American public as a restoration of economic sovereignty. But when you examine what's actually happened since these trade barriers went into effect, the outcome contradicts nearly every promised benefit. The effective tariff rate on goods entering the United States has rocketed to 15.4%, a level not witnessed since the Great Depression era of the 1930s. Even in scenarios where American businesses successfully shift their supply chains to alternative countries with lower duties, the rate only drops marginally to approximately 14.3%. That's barely a difference, and it provides virtually no meaningful relief to companies struggling with elevated costs. These additional expenses don't simply disappear into spreadsheets. They flow directly into higher prices for construction lumber, steel, concrete, consumer electronics, appliances, and countless everyday products that families depend on. Manufacturing plants are reducing worker hours and postponing expansion plans. Retail chains are raising shelf prices to maintain margins, and consumers, facing stagnant wages and rising costs, are pulling back on spending. The employment landscape tells its own troubling story. Job openings across the American economy have declined by 2% in just 1 month. When you compare current opportunities to the peak hiring period of 2022, overall job postings have plummeted by a full quarter, a 25% collapse in available positions. Professional white-collar roles remain 8% below where they stood before the pandemic began, while blue-collar manufacturing and logistics positions are shrinking as companies delay new orders and cancel investment projects. The timing of this employment crisis couldn't be more politically damaging. A prolonged government shutdown that stretched beyond 2 weeks left hundreds of thousands of federal workers without paychecks, creating cascading effects throughout local economies. Small businesses, from neighborhood restaurants to delivery services, felt the immediate impact as consumer spending evaporated in communities dependent on government salaries. Meanwhile, Chinese exporters have proven far more agile than Washington anticipated. Many manufacturers have quietly restructured their shipping routes, sending products through Vietnam, Thailand, Malaysia, and other Southeast Asian nations before they reach American ports. Others have re-registered their products under different trade classification codes, exploiting gaps and ambiguities in the tariff system. The result is predictable. American import costs continue rising, but China's overall trade surplus keeps expanding, largely unaffected by the barriers meant to constrain it. Even administration officials who championed these policies are now privately discussing extensions and truces, not because they represent strategic victories, but because they're attempting damage control. Every month these tariffs remain active, American supply chains become more fragmented, more expensive, and less competitive on the global stage. Investment analysts and market observers recognize what's unfolding. Corporate profit margins are compressing under rising input costs. Consumer confidence indicators are trending downward. Business investment is stalling as uncertainty mounts. Even the former president himself has acknowledged the fundamental unsustainability of the current approach. In a recent interview, when pressed about whether imposing a cumulative 157% effective tariff rate on Chinese goods could actually stand, the response was revealing. It's not sustainable, but that's what the number is. It's probably not. You know, it could stand, but they forced me to do that. I think we're going to be fine with China, but we have to have a fair deal. It's got to be fair. That admission, that the tariff structure is probably not sustainable, captures the predicament facing American policymakers. The trade war has evolved into something they can neither win decisively nor exit gracefully. And while Washington grapples with this dilemma, Beijing has already begun deploying a far more devastating economic weapon, one that doesn't target American exports at all, but rather the essential raw materials that make American production possible in the first place. The resource trap: how China controls what America needs most. If Washington's tariff offensive represents economic theater, Beijing's counter-strategy represents industrial warfare at its most sophisticated level. China has moved to restrict exports of rare earth elements, gallium and germanium, materials that sound obscure but are absolutely indispensable to modern manufacturing and defense systems. These aren't supplementary components that can be easily substituted. They are foundational inputs for semiconductors, electric vehicle batteries, advanced radar systems, precision-guided munitions, and fifth-generation fighter aircraft. Without steady access to these materials, entire sectors of the American economy and defense industrial base simply cannot function. China's dominance in this space is nearly absolute. Beijing controls more than 80% of global refining capacity for rare earth elements. While the United States does possess some domestic mining capability for these minerals, virtually all of the complex refining and processing occurs within Chinese facilities, where operational costs are substantially lower and environmental regulations are far less stringent than Western standards. Establishing new refining infrastructure in the United States or allied nations isn't a matter of political will. It's a matter of physics, engineering, and time. Building a single modern rare earth processing facility requires between 5 and 7 years from initial planning to full operation, with capital costs running into billions of dollars. This timeline makes rapid adjustment or emergency substitution essentially impossible. The economic impact is already measurable. Since Beijing tightened export verification procedures this summer, lithium carbonate prices, essential for battery production, have surged more than 40%. For American manufacturers already operating on thin margins due to tariff-inflated costs, these additional price increases represent a serious threat to profitability and competitiveness. The semiconductor industry faces perhaps the most acute vulnerability. The United States currently operates approximately 20 fabrication plants, primarily run by Intel and foreign companies like Taiwan, semiconductor manufacturing company that maintain American facilities. Yet every single one of these foundries depends heavily on Chinese processed materials for polishing silicon wafers, operating cooling systems, and sourcing the ultra-high purity metals required for chip production. If Beijing continues tightening these supply chains, American chip manufacturing could face serious production slowdowns or even temporary shutdowns. The artificial intelligence boom has temporarily obscured this vulnerability because domestic demand for processors remains strong enough to absorb everything American fabs can produce. But this balance is precarious at best. Beijing understands leverage in ways Washington seems to have forgotten. Every new export restriction serves as a calculated reminder that true industrial power doesn't originate from sanctions, tariffs, or political rhetoric. It comes from controlling the resources that make production possible. The implications extend beyond civilian manufacturing into national security itself. China's defense production capacity can currently scale at approximately 6 times the rate of American defense manufacturing under present conditions. As tensions escalate and military competition intensifies, this production gap represents a strategic vulnerability that cannot be addressed quickly. Looking ahead over the next decade, American defense and energy planners have identified more than 30 critical minerals as essential to national security systems. From lithium and nickel used in advanced batteries to gallium and rare earths used in everything from night vision equipment to missile guidance systems. Nearly every single one of these materials falls within China's sphere of control, either through direct mining operations or through downstream refining capacity. Washington officials have begun using terms like strategic vulnerabilities and supply chain resilience gaps to describe this situation. But those bureaucratic phrases obscure a more blunt reality. Without guaranteed access to these materials, crucial American industries, from electric vehicle production to hypersonic missile development, could face serious operational constraints or complete shutdowns. So while American policymakers continue focusing on restricting China's access to advanced AI chips and semiconductor manufacturing equipment, Beijing is quietly undermining America's ability to manufacture anything at all. Not just consumer electronics and smartphones, but the defense systems, communication networks, and weapons platforms that have underpinned American global military superiority for generations. The pressures generated by the trade conflict are no longer confined to import prices and manufacturing statistics. They're now rippling through the American financial system in ways that are beginning to alarm even seasoned Wall Street analysts. What started as elevated import costs has metastasized into a broader credit crisis affecting multiple sectors simultaneously. Over the past 4 weeks, a series of high-profile failures has rattled investor confidence and raised serious questions about the health of America's financial institutions. The auto lending company Tricolor abruptly filed for bankruptcy protection, leaving J.P. Morgan Chase with approximately $170 million in unrecoverable losses. Shortly afterward, First Brands, a major player in the private credit market, defaulted on more than $10 billion in outstanding debt obligations. These weren't minor players in obscure markets. These were companies that had thrived during years of cheap credit and were supposed to represent the success of private market lending. Then came the regional banking crisis. Zions Bancorporation and Western Alliance Bank disclosed massive loan fraud losses totaling $350 million. Triggering panic selling across the entire regional banking sector. Within just a few trading sessions, more than $100 billion in market capitalization evaporated from American bank stocks as investors rushed toward perceived safety. Financial analysts are drawing uncomfortable parallels to the Silicon Valley Bank collapse. Except this time, the contagion is spreading across consumer lending, automobile financing, and commercial real estate debt rather than being concentrated in a single institution or sector. This broader distribution makes it simultaneously less dramatic and potentially more dangerous. Rising interest rates have exposed weaknesses that were hidden during the era of near-zero borrowing costs. Many individual and corporate borrowers who could previously refinance their obligations easily are now defaulting as monthly payments climb beyond their capacity to service. Simultaneously, consumer spending is contracting because tariff-driven inflation has increased costs for vehicles, home construction materials, and electronic goods. When consumers reduce spending, businesses generate less revenue. When businesses earn less, they struggle to make loan payments. When loans default, banks tighten lending standards, which further restricts credit availability and compounds the economic slowdown. This is the classic feedback loop that economists fear most, a self-reinforcing cycle of inflation, rising defaults, and contracting credit that becomes progressively more difficult to interrupt. This financial turbulence is exactly what Washington policymakers dreaded when they first implemented aggressive tariff policies. Yet paradoxically, Trump's economic team is now using this very crisis as justification for demanding aggressive Federal Reserve intervention, specifically immediate and substantial interest rate cuts, regardless of whether inflation has been adequately controlled. The banking sector's distress has effectively become the perfect political argument for monetary easing, even if such action risks pushing both the dollar and the broader financial system toward a more fundamental crisis. Wall Street's pain has been weaponized into a policy demand that may provide short-term relief while creating far more serious long-term consequences. The financial system's fragility has handed the administration exactly the justification it needed to pressure the Federal Reserve into action. After months of deteriorating employment data and rising corporate bankruptcies, the White House is now framing aggressive interest rate cuts not as one option among several, but as an urgent economic necessity that cannot be delayed. Financial markets have absorbed this message. Traders now widely expect the Federal Reserve to implement a 50 basis point rate reduction before the end of 2025, a significant cut that would represent one of the most aggressive easing moves in recent years. Federal Reserve Governor Christopher Moran has advocated for a fundamental shift in the central bank's decision-making framework, moving away from data-dependent policy, which responds to actual economic conditions as they're measured, toward forecast-dependent policy, which acts preemptively based on projected future conditions. In practical terms, this means cutting interest rates before the economic data actually justifies such action. This approach might calm financial markets in the immediate term. Stock market indices have indeed climbed to fresh all-time highs, and gold prices have surged above $4,300 per troy ounce, as investors flood into tangible assets that historically preserve value during periods of currency uncertainty. But these very gains reveal something more troubling beneath the surface: a fundamental erosion of confidence in the U.S. dollar itself. The dollar index, which measures the greenback's value against a basket of major foreign currencies, has already declined nearly 9% so far this year. Currency analysts warn that 2 additional rate cuts of the magnitude currently expected could drive the dollar substantially lower. For average American households, lower interest rates might initially sound like welcome news. Mortgage rates could decline, credit card interest might ease, and business loans could become more accessible. But these apparent benefits come with significant hidden costs. As the dollar weakens, import prices automatically rise. Everything from gasoline to consumer electronics becomes more expensive. Inflation, which policymakers have spent the past 3 years trying to control, ticks back upward. Foreign investors, watching the dollar depreciate, begin withdrawing capital from U.S. Treasury bonds and seeking returns elsewhere. This capital flight, in turn, pushes more money into riskier assets: stocks, cryptocurrencies, real estate, creating asset bubbles that mask underlying weakness in the real economy of production, employment, and wages. The stock market rises while factories close. Wealthy investors see portfolio gains while middle-class families struggle with elevated costs. The political strategy is transparent: maintain elevated asset prices to keep markets satisfied, ensure credit continues flowing to prevent immediate economic pain, and delay any serious reckoning until after the next election cycle. But every interest rate cut chips away at global confidence in American economic management and the dollar's role as the world's primary reserve currency. As borrowing costs decline domestically, international faith in America's financial stewardship is quietly fragmenting. This loss of confidence is triggering a significant shift in global capital flows, one that's already begun to reshape how the world's largest economies finance their operations and store their wealth. Foreign appetite for United States Treasury securities is evaporating faster than Washington officials are willing to publicly acknowledge. America's two largest foreign creditors, Japan and China, are both systematically reducing their holdings of U.S. government debt. 20 years ago, Japan held nearly 40% of all U.S. Treasury securities owned by foreign governments. Today, that proportion has collapsed to just 13%. China's withdrawal has been even more dramatic. In 2011, Chinese institutions held almost 30% of foreign-owned U.S. debt. By this summer, that figure had plummeted to only 8%, and currency analysts project it will fall below 7% by October. This exodus isn't driven by political posturing or diplomatic tensions alone. The mathematics of holding U.S. debt have become increasingly unfavorable. With consumer price inflation running near 3.8% annually and average Treasury bond yields hovering around 4.1%, the real inflation-adjusted return barely compensates holders for the erosion of purchasing power. Factor in persistent trade tensions, the growing risk of asset sanctions, and the dollar's 8% decline this year, and even America's closest allies are beginning to diversify their reserve holdings. Central banks throughout Asia and the Middle East are now purchasing increasing quantities of gold bullion and bonds denominated in Chinese yuan, signaling a structural shift away from dollar dependence rather than temporary tactical adjustment. This isn't a short-term market fluctuation. It represents a fundamental reevaluation of where sovereign wealth should be stored. As foreign demand withers, the United States government is increasingly forced to borrow from its own domestic financial institutions, commercial banks, investment funds, pension systems, and insurance companies. This might function adequately in the near term, but it concentrates systemic risk within American borders. If the Treasury bond market experiences serious disruption, it won't be foreign central banks left holding worthless paper. It will be American pension funds, 401k retirement accounts, mutual funds, and community banks that absorb the losses. The Federal Reserve has already quietly resumed purchasing Treasury securities in secondary markets to stabilize auctions and ensure successful debt sales. But each new round of central bank intervention deepens international skepticism. Global investors increasingly perceive an economy financing itself through its own monetary creation, a pattern historically associated with declining empires and deteriorating currencies. Once confidence in Treasury securities begins to fracture, that loss of faith doesn't remain contained. It spreads rapidly throughout the entire architecture of American financial power, affecting the dollar's exchange value, the credibility of U.S. economic statistics, and ultimately the geopolitical influence that financial dominance has provided for decades. Washington is systematically running out of foreign support for its debt burden, and the costs of that isolation are beginning to manifest in ways that extend far beyond interest rates and bond auctions, reaching into the very foundations of American economic sovereignty and global influence. The administration's economic advisors have arrived at an inflection point where every available path forward carries severe consequences. They can implement sharp interest rate cuts and risk accelerating the dollar's devaluation, or they can maintain higher rates and watch the banking system buckle under mounting stress. Both directions lead toward serious economic pain, one through resurgent inflation and currency crisis, the other through credit collapse and recession. For now, the political calculation favors cheaper money. The bet is that reduced borrowing costs will buy enough time to navigate past the next electoral cycle. But global financial markets are already responding to this approach. The dollar has fallen nearly 10% year to date, while gold, oil, and other commodities continue surging as investors abandon currency positions in favor of tangible assets with intrinsic value. Every subsequent rate reduction erodes international confidence in the stability and management of the American financial system. The implicit promise that once defined the dollar, safety, reliability, and purchasing power preservation, is visibly fading in real time. China, meanwhile, is maintaining its position with remarkable discipline. Rare earth export restrictions remain firmly in place. Manufacturing capacity continues expanding at unprecedented rates, with new factories, ports, and logistics networks coming online quarterly. Chinese exports sustain their growth trajectory, and the yuan is becoming increasingly common in regional trade settlements, slowly displacing the dollar in Asian commerce.